welcome to Everything You Need to Know About Finance. Today, we're taking a real deep dive into the S&P 500.
It's a big one, definitely central to understanding the U.S. market.
Absolutely. Now, before we really jump in, just a quick reminder for everyone listening.
Yes, the important bit.
Right. Everything we talk about today is purely for informational purposes. It shouldn't be taken as financial advice. Always do your own research or consult a professional.
Couldn't agree more. So, information, not advice. Got it.
Okay. So you, our listener, you've told us you want to grasp things quickly, but also thoroughly. Today, we're aiming to unpack the S&P 500 for you, give you the essentials, maybe some surprising facts, without getting too bogged down.
Sounds like a good plan. Where should we start? The basics.
Let's do that. So first things first, what exactly is the S&P 500?
Okay, well, put simply, it's a stock market index. Think of it like a gauge.
A gauge.
Yeah, measuring the performance of 500 of the biggest, most established companies listed on U.S. stock exchanges.
500.
Okay.
And why these 500? Why is it so important?
Well, because these companies are so large and influential, the index covers about, let's see, roughly 80% of the total value, the market capitalization of all publicly traded stocks in the U.S.
Wow, 80%.
Yeah.
That really puts its significance into perspective, doesn't it?
It really does. It's a major benchmark for the health of the U.S. stock market and even the broader economy sometimes.
Okay, so it's a big deal. When did this index actually, get started?
Right. The S&P 500, as we know it today, that was launched on March 4th, 1957.
1957, so mid-century.
Yeah, but the history goes back further. Standard Statistics Company had an index in 1923 tracking 233 stocks.
Oh, interesting.
And even before that, you had Poor's Publishing way back in 1860, initially tracking railroad companies.
Railroads, wow.
Yeah. Poor's and Standard eventually merged in 1941. That's how we got Standard & Poor's, or S&P.
That's quite a lineage.
Yeah.
And who runs the show now? Who manages the index?
That would be S&P Dow Jones Indices. They're the ones who maintain it, decide which companies are in or out.
Okay, so they decide who makes the cut. It's not just like an automatic thing based on size.
Not entirely automatic, no. There's a committee, and they use specific criteria.
Criteria like what?
Well, market capitalization is a big one. As of early 2025, a company generally needed a market cap of at least $20.5 billion.
$20.5 billion. Okay.
Then there's liquidity. The stock has to be easily tradable.
Right. Makes sense.
So they look for a minimum trading volume, like 250,000 shares traded each month for the last 6 months.
Okay.
And of course, it has to be listed on a major U.S. exchange. Think NYSE, NASDAQ, CBOE.
Got it. So market cap, liquidity, listing, pretty rigorous.
It is. It ensures the index represents large, actively traded companies.
I also saw this term, weighted by free float capitalization. What does that mean in plain English?
Good question. So free float refers to the shares that are actually available for public trading.
As opposed to shares held by insiders or governments.
Exactly. Shares that are locked up, restricted shares, those don't count towards the free float. So the index gives more weight to companies with a larger value of shares that you or I could actually buy on the market.
Okay, so the bigger the available chunk of the company, the more influence it has on the index's movement?
Precisely. And it's quite concentrated at the top. As of, say, April 2025, the top 10 companies.
That's big names, I assume.
Oh, yeah. Apple, Microsoft, NVIDIA, Amazon, Alphabet, Google's parent company, Meta, Berkshire Hathaway, Broadcom, Tesla, JP Morgan Chase. Those 10 made up roughly 35% of the entire index's value.
35% for just 10 companies. That's quite a concentration.
It is. It means the performance of those giants has a really significant impact on the overall index.
Any other interesting tidbits about the index components? I think I read something about dividend aristocrats. Sounds fancy.
It does sound a bit regal, doesn't it? The dividend aristocrats are a specific group within the S&P 500. They're companies that have not just paid dividends, but have increased their dividend payout every single year for at least 25 consecutive years.
25 years straight. Wow.
Yeah, it's often seen as a sign of, financial stability and a real commitment to returning value to shareholders.
That makes sense. What about the global reach of these companies? Are they purely U.S. focused?
Not at all. Collectively, S&P 500 companies actually get a significant chunk of their revenue from outside the U.S. It's around 28%, with about 72% coming from domestic sales.
So they're major U.S. companies, but with a definite global footprint.
Definitely. And here's another interesting link. The performance of the S&P 500 is one of the components used in calculating the Conference Board leading economic index.
Ah, the LEI. So the index performance actually feeds into economic forecasts.
Exactly. It's considered a key indicator of business conditions and potential future economic activity.
Fascinating how it's all interconnected. Okay, let's shift gears slightly. If someone listening wants to, invest in the S&P 500, how do they do that? I saw some ticker symbols mentioned, like GSPC.
Right, GSPC, .INX, SPX. Those are ticker symbols for the index itself. You can't directly buy the index per se.
Okay, so how do you track it?
The most common way for most people is through index funds. These can be mutual funds or, very popularly, exchange-traded funds, ETFs.
ETFs, right? I've heard of those, like SPY.
Exactly. SPY is the ticker for the SPDR S&P 500 ETF Trust, one of the oldest and largest. Others are IVV and VOO. These funds basically hold all 500 stocks in roughly the same proportion as the index itself, so their performance closely mirrors the S&P 500.
So buying shares in SPY is like buying a tiny slice of all 500 companies.
That's a great way to put it. There are also leveraged ETFs like SPXL or UPRO, which aim to give you, say, 3 times the daily return of the index. But
More risk, I imagine.
much more risk, yes. And they're designed for short-term trading, generally not long-term holds. More sophisticated investors might also trade S&P 500 futures or options on exchanges like the CME or CBOE.
Okay, so options for different levels of investors. Now, you mentioned S&P manages the index, and they also sell rating services. Is there any potential issue there?
Well, it's something that's been raised. A study some years back suggested there might be a correlation, a possible link between companies that purchase rating services from S&P Global, the parent company, and their likelihood of being added to the index.
So a suggestion of potential influence.
Just a suggestion from that study. It certainly gives you something to think about regarding the selection process, which is often presented as purely objective, makes you consider the different factors potentially at play.
Definitely food for thought. Okay, let's move on to performance, which I know you, our listener, are really interested in understanding. What's the historical track record like?
Looking way back, since 1926, the compound annual growth rate, the average yearly return if you reinvest everything, has been roughly 9.8%.
Almost 10% per year on average. That sounds pretty good.
It is, over the long haul. But that includes inflation. After you factor in inflation, the real return is closer to 6% per year.
Still 6% above inflation over nearly a century.
It's solid, and this is crucial, that's an average. It's definitely not a straight line up. There's volatility.
Volatility meaning ups and downs.
Exactly. One measure of that is standard deviation. The monthly standard deviation has been around 20.81%. Think of that as a measure of how much the returns can swing month to month. It can be a bumpy ride.
So not always smooth sailing, but the general trend over the long term has been positive.
That's the historical pattern, yes. The index has actually finished the year with a positive return in about 70% of the years.
70% of the time, okay.
And when you see returns quoted, it's important to know if they're talking about just the price increase of the index or the total return.
Total return includes dividends.
Right. Total return assumes you reinvested all the dividends paid out by the companies in the index. That gives you a much fuller picture of the actual growth an investor would have experienced.
Okay, let's make it concrete. Can you give us some examples of those total returns for specific years? Maybe a mix of good and bad.
Sure. Let's look at total return, including dividends. Take 1970, it was up 4.01%. Not huge, but positive.
Okay.
Then jump to 1974, that was a tough year. Down 26.47%.
Wow.
But then look at 1980, a strong recovery, up 32.50%.
Quite a swing.
Absolutely. Fast forward to the global financial crisis. 2008 was the worst year in recent memory, down 37.00%.
Minus 37%. Wow.
Yeah, brutal. But then again, more recently, 2020, despite the pandemic kicking off, the index finished up 18.42%, and 2024 was strong too, up 25.02%.
So huge variability year to year. What were some of the absolute best and worst years since, say, 1970?
The highest total annual return since 1970 was actually 1995, a massive 37.58% gain.
Incredible.
And the lowest, as we just mentioned, was that Neckar 37.00% in 2008. So the range is really wide.
That definitely highlights the risk and reward over a single year. What about smoothing things out?
Yeah.
Looking at returns over longer periods, like 5 or 10 years.
That's often a more useful perspective for long-term investors. When you look at the annualized return over several years, it averages out those big swings.
Can you give an example?
Sure. Let's say you were looking back from the end of 1989. The previous 5 years, from 1985 through 1989, the average annual return was 20.37%.
So even though individual years within that period might have varied, the average over the 5 years was very strong.
Exactly. This longer view helps illustrate the power of compounding and why many people invest in index funds for long-term goals, despite the inevitable down years. It helps you ride out that volatility we talked about.
That provides a much clearer picture of the long-term potential, balancing out the year-to-year noise.